Hello and welcome. All right, let's talk about the big one, the new Income Tax Act 2025. It's on the horizon and it's bringing a lot of changes. Today, we're going to dive deep into a section that is absolutely crucial for any business or profession, Section 62. This is all about maintaining your books of account. And trust me, you'll want to get this right, because getting it wrong could mean some pretty serious penalties.
So let me just ask you this straight up. If you're running a business or you're a professional, are your records actually ready for what's coming? We're talking about the new Income Tax Act taking effect. This isn't just some minor update we see every year. It's a brand new act. So understanding what you need to do right now, well, that's everything when it comes to staying compliant.
Okay, so here's what we're going to cover. We'll start with why you even need to maintain books. Then we'll get into who has to keep these records, what exactly you need to maintain, and the rules you've got to follow. After that, we'll look at the penalties and some common issues, and we'll wrap it all up with a handy compliance checklist.
All right, let's start at the beginning. Why maintain books? Why does this matter so much? Look, proper record keeping is way more than just paperwork. It's truly the foundation of all your tax compliance.
The main goal of Section 62 is actually pretty simple and logical. It's all about making sure the assessing officer can accurately figure out your total income. Think of it like this. Your books tell the financial story of your business for the year. If that story is clear and verifiable, it leads to transparency, accuracy, and ultimately, a fair assessment for everyone involved.
Okay, so that brings us to the big question. Who actually has to follow these rules? Let's get into the applicability test and see if this applies to you.
So, Section 62 basically divides taxpayers into two main buckets. In the first bucket, you've got specified professions. Now, if you're in this group, it's mandatory. You have to maintain books. Period. Income doesn't matter. In the second bucket, you have businesses and all other professions. For you guys, it all hinges on whether your income or turnover crosses certain thresholds.
And here are those specified professions we just talked about. We're looking at legal, medical, engineering, architectural, accountancy, a whole list here including technical consultancy, interior decoration, IT, and company secretary. So if your work falls into any of these categories, you're automatically covered by Section 62.
Now, for those of you familiar with the old Act, this is where it gets interesting. Section 62 of the new 2025 Act is basically the successor to Section 44AA of the 1961 Act, and you can see some key changes. The income and turnover thresholds have been updated and, frankly, simplified. But the biggest and most welcome change for many of us, we're finally moving away from that confusing previous year and assessment year jargon to just one simple term, tax year. Much easier to follow, right?
Okay, so let's talk about that second category, businesses and other professions. Here's your first condition. You have to maintain books if your total income goes over 250,000 rupees. And here's the key part. This isn't just for last year. It's if your income crossed that mark in any one of the 3 tax years right before the one we're in.
And there's a second condition too. Let's say your income is below that 2.5 lakh limit. Well, you're not off the hook just yet. You still have to maintain books if your total turnover, that's your sales or gross receipts, is more than 25 lakh rupees. And again, the rule is the same. This applies if you cross that threshold in any one of the 3 preceding tax years. So yeah, you've really got to watch both your income and your turnover.
Okay, so let's say these rules apply to you. The next logical question is, what books do I actually need to maintain? Let's get into the specifics.
All right, Rule 46 gives us the list. You'll need the essentials, a cash book, and a ledger. Now, if you're using the mercantile system of accounting, where you record transactions when they happen, not necessarily when the money actually moves, then you'll also need a journal. On top of that, you need to keep serially numbered copies of all the bills you issue, and of course, the original bills for all your expenditures.
Now, for all the medical professionals out there, listen up, because there's one extra requirement just for you. You have to maintain a daily case register in what's called Form Number 25. It's basically a detailed log of your patients, the services you provided, and the fees you received each day.
Okay, so now we know what books to keep, but what about the how and the how long? Let's cover the practical rules for actually keeping these records.
The law is super clear on this one. Your records have to be kept and maintained at your principal place of business or profession. Simple as that. Now, if you need to keep them somewhere else, that's fine, but you must inform the assessing officer in writing and provide the full address of that new location.
So, how long do you have to keep all this paperwork?
The magic number is 6 years. You need to hold on to your records for 6 years from the end of the relevant tax year. But, and this is a huge but, if an assessment for one of those years gets reopened, you have to keep those specific records until the entire proceeding is finished, no matter how long that takes.
All right, we've talked about the rules. Now we have to talk about what happens if you don't follow them. Let's get into the penalties and some of the common practical mistakes people make so you can avoid them.
So what are the stakes here? What actually happens if you just don't maintain your books correctly, or you don't keep them long enough? What's the damage?
The number you need to remember is 25,000 rupees. That's the flat penalty under Section 441. But honestly, it's not just about the 25,000. Think of that penalty as a massive red flag for the tax department. It could easily lead to a much deeper scrutiny of your accounts. So yeah, it's a simple mistake, but one that could end up being very, very costly.
So let's talk about some of the common pitfalls we see all the time. A big one is simply not starting to maintain records even after you've crossed the thresholds, or on the flip side, tossing them out before that 6-year period is up. We also see people forget the special rules, like that Form 25 for medical professionals. And a really simple one, keeping records somewhere else but forgetting to tell the AO. And please, remember this, incomplete or inaccurate entries can be just as problematic as having no records at all.
Okay, that was a lot of information. So to make sure you've got everything straight, we've put together a quick compliance checklist with all the key takeaways.
So, number 1, identify your category. Are you a specified profession or are you in the business bucket? 2, check your thresholds. If you're in business, you have to constantly monitor your income and turnover against those 2.5 lakh and 25 lakh limits. 3, maintain the prescribed books. Make sure you have everything Rule 46 asks for, the cash book, ledger, bills, the whole 9 yards. 4, retain everything for 6 years. Don't throw anything out before then. And finally, number 5, avoid that penalty. Always remember that 25,000 rupee fine is waiting if you slip up. Nailing these 5 points is how you master Section 62.
And there you have it, a deep dive into Section 62. I really hope this breakdown helps you get ready for the new act. If you found it useful, do me a favor and hit that like button, subscribe for more explainers like this one, and maybe share it with a colleague or friend who might need it. Thanks so much for watching.
Just a quick disclaimer before we go. This presentation is for educational purposes only and shouldn't be taken as professional advice. Tax laws are always subject to change, so please always consult with your professional advisor before you take any action. And just for transparency, this is an AI-generated educational video.